Argus Media, this is Driving Discussions, a podcast series focusing on the forces that affect North American road fuels. Greetings and salutations once again, one and all. I'm Jason Metko, Associate Editor of U.S. Products, and on this edition of the series, we're catching up with Argus's America's Freight Deputy Editor, Ross Griffith, with a look at U.S. refined products exports tying into the world of freight. Ross, welcome to the presentation for the first time. We've had quite the heavy maintenance season for refiners in the Gulf Coast recently conclude. Let's lead this off by telling us a little bit about how that's translated shipments from the region.
Hey, Jason. Thanks for having me. So that's right. As your listeners are likely aware, one of the heaviest maintenance seasons has finished for U.S. Gulf Coast refiners, and refinery utilization in the region has held at or above 90% since mid-March. And freight rates for medium-range tankers, and these are the primary transport vessels for refined product cargoes like diesel, gasoline, and naphtha, they hit 2024 highs around this time, but since April 1st, rates have pushed steadily down to 2024 lows. And this is on an influx of tonnage because European refiners are having a similarly heavy maintenance season this year that's largely removed this major exporter from the Atlantic basin. As far as ship operators are concerned, they have been mostly pushing over to the U.S. Gulf Coast instead. So this influx of tonnage has only just begun to clear on an uptick in what is mostly transatlantic and Caribbean demand. And there is some West Coast South American demand from buyers in countries like Chile and Peru. That's also been rising in recent weeks, but we'll get into that a little more when we talk about the Panama Canal situation. But trade to Europe is primarily focused on diesel, and demand for diesel has picked up since late April. But one of the interesting components of this European demand is that the Houthi rebel attacks on commercial vessels in and around the Red Sea, these have rerouted most vessels around the Cape of Good Hope instead. So this has made naphtha delivered to Europe from the Mideast Gulf much more expensive from a freight perspective compared to an equivalent Suez Canal transit, and is likely a major driver in any heightened European demand for naphtha that we're seeing from the U.S. Gulf Coast. So U.S. Atlantic Coast gasoline buyers will become more active as the summer driving season approaches, and European gasoline blenders are likely stocking up with naphtha, which a lot of the trades were saying, which U.S. gasoline grades typically require a higher proportion of. So they're looking to meet that demand in the coming weeks, coming months. At the same time, Caribbean demand has jumped pretty significantly in the last few weeks, with waves of Caribbean demand clearing multiple MR tankers from the market within single trading days, helping ship owners to step back into the driver's seat of the market. And these trades, these are diesel, gasoline trades primarily. There's some naphtha and jet fuel in that as well.
He is America's Freight Deputy Editor Ross Griffith. This is another edition of Driving Discussions. Ross, Mexico, as we all know, is a major importer of gasoline from the Gulf Coast refineries. But we've got a new refinery coming online as we speak down in Olmeca. How's that going to affect trade from the region?
So this is a big topic, and a lot of people are looking at this. This is all happening as we're talking right now. I believe this week even we're going to start seeing the first diesel out of the Olmeca refinery. Utilization in Mexican refineries altogether has been historically well below that of U.S. refineries, which has contributed to Mexico's dependence on seaborne imports of refined products like gasoline and diesel. Now, the opening of the Olmeca refinery is the next step in what is an ongoing campaign by the country to reduce its dependencies, and there are signs that Mexican demand is preparing to contract in the near term. Mexican state-owned Pemex's 6 existing domestic refineries boosted gasoline and diesel output in March by something like 30%. And it seems as though, at least in the spot market for MR-sized cargoes loading in the U.S. Gulf Coast, that Mexican demand has dipped compared to late 2023. So PMI is Pemex's trading arm. They don't actually own their own MR vessels, and instead they utilize long-term contracts called contracts of affreightment. In this kind of contract, it allows the company to get favorable prices while the ship operator has the freedom to choose which vessel to supply for the trade. So that allows them to manage their fleets to their advantage. And when Mexican demand outstrips these already contracted flows, then PMI will enter the spot market. And Mexico is the single largest state importer of refined oil products from the U.S. Gulf Coast. So when PMI does enter the spot market, they often do so en masse. They scoop up a large number of MRs in a single trading day, sometimes 4 or 5 vessels. And this can very quickly and radically shift the tonnage profile in the region overall and quickly pressure freight rates higher. So, although we've seen European and Caribbean demand ramping up in recent weeks, Mexican demand has not re entered that spot market in the same way that it has in the past and certainly was in late 2023. This is kind of suggesting a shift and suggesting that ship owners may increasingly need to stop counting on sort of this return of Mexican demand as a sort of quick solution to downward pressure on freight rates at any time, in the region, especially once the Olmeca refinery is fully operational, and certainly if Pemex can maintain the recently higher output from its other facilities.
I want to go back real quick and talk about the Panama Canal because there's a drought going on down there. What's the impact to U.S. refined product shipments around there?
Sure. Well, to be honest, many people are unaware of how the Panama Canal functions or why exactly a drought can affect a waterway that connects two oceans. And the easy way to understand the construction of the canal is that digging is hard and flooding is easier. So it's a freshwater canal fed primarily by the man-made Gatun Lake that depends on rainfall for replenishment. With the entire waterway sitting above the Atlantic and Pacific sea levels on either side of it, thus requiring the locks that vessels enter, which raises them up to transit before lowering them back down to exit back into either basin. But severe drought as part of the El Nino weather pattern beginning in early 2023 dropped water levels in the Gatun Lake to the lowest recorded levels since measurements began in the 1960s. And the Panama Canal Authority that oversees the waterway, they restricted the number of daily transits at the canal and switched the system for transit from first come, first serve. And these included optional auctions. You could bypass the line. But now they only offer pre-book slots, and these sell out very quickly, pre-book slots to transit, and supplement these slots with a much more competitive auction system. These are the only ways to pass through the Panama Canal anymore. There's no more waiting system, essentially. So Chile is the second largest single state importer of refined products from the U.S. Gulf Coast. And this is followed by Peru. So buyers in these West Coast South American countries have had to contend with significant auction costs, increasing the overall weight of freight. And the weight of freight, that's the percentage of the total cost of shipping a commodity made up by the freight part of the equation. So this had the effect of pushing West Coast South American and Central American buyers towards West Coast North American products when possible. Because exportable output from this region is dwarfed by U.S. Gulf Coast supply. They just simply can't send nearly as much. So Asia Pacific supply has been helping to make up the deficit for a lot of these Pacific Basin buyers in the Americas. So high U.S. gasoline stocks have likely been exacerbated by lower exports from the U.S. Gulf Coast into West Coast Central America and West Coast South America, directly as a result of Panama Canal disruptions this year and late last year. U.S. Gulf Coast exporters shipped something like 162,000 barrels a day of diesel, 138,000 barrels a day of gasoline into Chile, West Coast Mexico, Peru, Ecuador, and West Coast Panama from the 1st of January to the 1st of May 2024. Now, that's down quite a bit from what they were sending in the same period, 2023, at 194,000 barrels a day of diesel, 167,000 barrels a day of gasoline. So looking ahead, the Panama Canal Authority is set to increase the number of daily transits through the Panamax locks, the ones utilized by MR tankers, by 3 daily to 24 total on May 17th. And that's as the rain season gets back underway. And that rain season usually ramps up from May before tailing off by the end of the year. So this could help return additional demand from the Pacific side of the canal back to the U.S. Gulf Coast, help to draw down some of these U.S. stocks in the near term, but an uptick in available Panamax locks, transit slots, does not guarantee the end of volatility at the Panama Canal. There's there's quite a bit going into this whole equation. To give an example, the Argus assessed Panama Canal auction prices in the larger Neo-Panamax locks. These are the newer locks for much larger vessels. These surged on Monday. They jumped to just shy of $900,000 lump sum, and again, that's $900,000 just to win an auction and secure a transit slot, which was a 76% week-over-week jump. And all this was on an influx of LPG demand carried on very large gas carriers. So these same vessel operators were paying upwards of $1.7 million to secure auction slots by Wednesday. So just 2 days later. So it's an incredible jump, in these auction prices, just driven by demand within these vessel segments. There was no change in supply of these transit slots. They were static, during this time. So Argus assessed Panamax lock auction prices were at just under $170,000 on Monday, but a similar swing in demand for another vessel segment utilizing these same Panamax locks would quickly dampen any increase in demand. The uptick in available transit slots could encourage from Pacific Basin buyers. So that's always the concern.
Couple more minutes here with our guest this week. It's America's Freight Deputy Editor Ross Griffith here on Driving Discussions. So, Ross, if you are a Gulf Coast exporter, you've got quite a lot to consider here the next few months. We're already middle of May. You've mentioned a few of these things, but what else do you see the big picture here as we go through calendar year 2024?
Well, certainly all eyes will be on the Panama Canal, definitely in the coming weeks, the coming months, to see just how this unwinding of restrictions plays out. We know from late 2023, when some U.S. Gulf Coast loading rates hit all-time highs, the changes to canal transit rules can very quickly pressure freight rates. So it will be very interesting to see just how smooth the transition back to normal operations will be. We have the return of some Maersk container ships this month. And that'll also be playing into heightened demand at the canal. Some of their liners, some of these Maersk liners, were utilizing railroads through Panama. They were unloading containers on one side from a vessel, loading them back on the other side to a separate vessel, and just bypassing the canal that way. So a lot of those are returning to the canal, and there will be additional competition for transit slots, which could filter into the market soon here from the return of dry bulkers, whose operators are likely eyeing these relatively low auction prices for Panamax lock transits in recent weeks. Larger bulkers should start to transit again as well in June, when the Panama Canal Authority raises the maximum draft for the larger Neo-Panamax locks. This was another water-saving measure that has largely pushed out Panamax, Kamsarmax, dry bulkers, and we might see those vessels beginning to return as well as they continue to raise this maximum draft. But I am also very curious about how the Houthi situation in Yemen plays out, whether Suez Canal transits become part of the overall equation again in 2024. Certainly from a freight perspective, vessel operators don't mind inefficiencies or reroutings. These tend to increase ton-mile demand. They boost rate, they slow the return of tonnage to the global fleet, so that's lowering competition among ship owners. So the most interesting aspect of this in terms of U.S. exports has been that rise in naphtha demand from European buyers in the U.S. Gulf Coast. As part of the overall European demand picture, a major facet of the market that we haven't really touched on yet is the lack of Brazilian demand for U.S. Gulf Coast loading oil products. Buyers in the country have largely shifted over to Russian product instead, which has cleared the way for a lot in the European diesel demand. A lot of this European diesel demand we're seeing instead from the U.S. Gulf Coast, there's just quite a bit more available with the absence of those Brazilian buyers. But that being said, the drop Brazilian demand, potential for lower Mexican demand by the end of the year could seriously boost MR vessel supply around the U.S. Gulf Coast. East Coast Mexico-bound voyages from the region are short, but ports on the country's east coast are often congested, and this congestion can tie vessels up and kind of hold on to them. So heightened demand from Europe is really unlikely to move and to retain as many vessels as these Brazilian and Mexican trades have in the past. Certainly have in previous years. So that being said, it's an interesting situation right now where high U.S. gasoline demand this year could lead to higher European naphtha demand for gasoline blending, thereby helping to support U.S. Gulf Coast refined product exports. And this is at a time when disruptions from the war in Ukraine, the drought-afflicted Panama Canal, these are meeting with an uptick in Mexican refining output, all of which are shrinking previously strong sources of U.S. Gulf Coast demand. So this jump in naphtha trade to Europe, even that is brought about in the first place because of disruptions in Suez Canal transits from Houthi attacks on commercial vessels, cutting off the ease of access to Europe for Mideast Gulf suppliers. So each of these trades are interesting, and they're all in flux, at the moment. So very, very interesting to see where it kind of leads to.
Yeah, certainly a weight on freight going forward here. And speaking of weight and freight, let's give you a chance to cross-promote here the Weight of Freight podcast series. Tell us a little bit about what you're doing over there, Ross.
Absolutely. So anybody who's interested in any kind of seaborne freight, seaborne transit for refined oil products, certainly, as well as crude, and anyone interested in dry bulk who's listening as well would find some interesting things there. What we do is we look at the what I mentioned just a little bit earlier, the weight of freight, or the percentage at which freight makes up your total landed cost to move a commodity, to purchase and move a commodity. And it is a great series that will really help you to see these different factors that are going into trade at any moment. If you've been curious why freight prices on routes you're looking at have been jumping, or why they're at recent lows, you can usually find some great information in our podcast series. We also have articles we're writing for this series with a lot of great info. So if you have the time, definitely check it out.
Ross, thank you for your time today. We hope to have you back on Driving Discussion soon, sir.
All right. Well, thank you so much, Jason.
He's Argus America's Freight Deputy Editor Ross Griffith, and we do thank him for spending a few moments with us. And a reminder to check out his podcast series, The Weight of Freight. It really is worth the listen. With that, we'll conclude another edition of Driving Discussions, a podcast production of Argus Media, a leading independent provider of commodity pricing information. Reminder to check out the previous episodes in this series, as well as The Weight of Freight. And for the latest and greatest in all things that Argus covers as far as U.S. products are concerned, make sure you check out argusmedia.com/US-products.